Hi everyone, I'm David.
And I'm Clarence.
We are from Infinity Financial Advisory, and today we will be sharing about the topic on bonds.
So there's a very interesting trivia on bonds, right? So do you know historically that the first bonds is actually created by the East India Dutch Company, right? So they use it to actually finance their maritime activities. So do you know which historical figure in Singapore is related to this company?
I think probably Stamford Raffles.
Exactly. So can you imagine if there's no bonds being created?
It might not be a Singapore.
Exactly. So he might not find the little red dot.
Wow. So bonds is actually quite intertwined in our history. Yeah.
So let's look at our first question for today, right? So how do bonds work?
Okay. So from bonds, right, is actually issued from companies to raise funds. Just like how companies, they raise funds through issuing shares, right? Investors buy shares, which we are very aware of, right? And so the same company can also issue bonds to fundraise, right? So unlike shares, bonds actually pays a coupon on a yearly basis, semi-annual basis, some of them, right? And towards the end of the tenure, they just return you back your principal.
Oh, so in very layman term, can we say that bonds is like IOU?
Yeah, I think it's something like that.
Okay.
Do you think that we can make money with bonds?
Definitely, we can make money with bonds. And in fact, there's a few ways that investors can actually make money by a bond. So the first way, which I would think that is a main way, is like what you mentioned. Like the bonds will pay out coupons, which is the interest from the principal that the investor invests in, right? So let's say, for example, 3%, 5%, right? Sometimes even you have 10, 20% bonds. So these coupons will be the main stable income that these investors, when they invest in the bonds, they will be looking at. So the other way that the investors can actually make money from bonds will be from the price difference that they can gain, the capital gain, right? So for example, if like in the last few years, when interest rate went up, the bond price will actually drop, right? So if investors can actually buy into a lower price bond today, as the interest rate market normalize, bond prices might be pushed back up. So this may actually create a capital gain for the investors. So these will be the two main ways that investors will be able to make money from investing in bonds.
Seems like they probably don't have to hold to maturity as well, right?
Yes.
They can just sell and make a capital gain.
Correct.
Okay.
So there might be people that will ask, so why is there this inverse relationship, right, between the interest rate market and the bonds? So I'll give you an analogy. So today, if I buy a bond, right, for 5%, that pays up 5% with $10,000.
Yes.
Right. So maybe 1 year down the road, interest rate went up. So the new bonds, right, will have to give a more attractive bond interest. So for example, they pay 6%. So with the same $10,000, investors can buy a 6% bond coupon. So versus my 5%, right, it's less attractive now. So if I want to sell it, I can't be selling at 10,000, right? Nobody will buy. So I may have to sell it at 9,000, 9,005.
That's true.
So conversely, in the reverse happen is the same.
Okay.
Right. If interest rate drops, right, then the new bonds that is being launched will be at a lower interest rate.
Yeah.
So the bond that I'm holding now with 5% looks more attractive.
Yeah.
So I could sell it to people at 10,001.
That's a very good example.
Yeah. Is bond investing the safest type of investment, David?
I believe in this world, there's nothing that's the safest, right? The safest thing is put your money under the blanket, right, under your pillow. But again, you also lose to inflation.
I would say that. To rest.
Yeah, my belief is always that investing in yourself is the safest investment, right? You will never go wrong.
Yeah,
right? The time and effort that you put in, right, will compound through time also, not just investments. But now, since we are talking about bonds, right? So bonds, there's a spectrum of different type of bonds, right? From lower risk bonds to higher risk bonds. So how do they be graded in this way? So lower risk bonds are usually bonds that are more stable, has better financial backing, or even government backing. For example, the Singapore government bonds, right? They tend to have lower risk, which means they are more likely to pay you back your capital during maturity, simple terms, right? Whereas higher risk bonds are bonds that their financial standing might not be as strong, and they might have a risk of not returning you your capital at the end of the maturity.
Okay.
So in this whole spectrum of bonds, it depends on various investors' risk appetite, right? And they choose what kind of bonds they want to invest in.
Okay, so is there some example whereby bond investor may
Yeah.
be caught off guard?
I think recent years there's bonds like high flux bonds, cyber
yeah,
bonds, right? I think
okay.
you've heard that in the news, right? So what happens is that investors can't get back their principal. And the very interesting thing is that these bonds are once thought to be safe as well. So you can see that there are also risks investing into a single bond, right? And investors could also lose their capital. But at the same time, I think recent years, people have been chasing bonds like T-bills, MAS, issued Singapore savings bonds, right? Those bonds generally, you can sleep through the night holding those bonds, right? But the downside, they tend to pay lower interest, right? For these bonds that has lower risk. Okay.
So we can also, from your example that you may have mentioned, so a good way to gauge the risk of a bond could be from their interest that they're paying, right? So a lower interest, like one I mentioned, Singapore savings bond, would be deemed to be safer. But the higher interest, let's say for example, those corporate bonds, maybe even junk bonds, so generally they'll be giving a higher interest, 6%, 7%. So an investor will be able to look at the coupons rates to determine the amount of risk inherent into
I
these
would
bonds.
think that the market might price in the risk, like what you say, right? But sometimes, like just now what I mentioned, like high flux bonds, right? Before things go south, right? It also pay relatively okay returns, right? Average returns, right? So I think that's why being a bond investor, you need to be a bit more sophisticated. That's where I think it comes to our next question is that do you have to be rich to buy bonds, right? I think buying direct bonds usually are only catered or open up to investors who are accredited investors, meaning that they make 300K a year or have $1 million in assets and above, financial assets, right? So in this case, bonds are definitely more sophisticated than buying stocks because besides looking at the interest rates, where we have to look at the crediting risk, and many times crediting risk could change within a year. You know, suddenly, like recently, the China property bust, right? There's certain bonds like Evergreen. So there are
Or
some
the
of
property development.
property development bonds, right? So
In
what happens
China.
is that, they were once good grade bonds. Who would have thought that it has dropped quite a bit, right? But are there good examples of bonds, right? I think recently my clients, who invest in bonds, they make quite a bit, right? By investing into investment grade bonds, right? That pays them relatively good interest rates. At the same time, the price fluctuation is not high, right? So that begs the next question, you see. So is it only the rich that can buy bonds?
Right. Definitely not, right? Because I think in the market today, there are a lot of different type of bonds that is available for different type of investors.
Okay.
Right. So we don't have to be very rich like your clients to buy all these wholesale bonds, AI bonds. So there are also like bond funds, bond ETF, whereby the retail clients can actually access to them with a very minimum startup amount.
Okay.
You could invest in them from a few $100s onwards.
Okay.
Right. So I think the other good thing about this kind of bond ETF and bond funds is that instead of instead of investing everything into one concentrated bonds, right? These ETF and bond funds actually allows them to invest into a whole portfolio,
Okay.
a whole basket of different bonds managed by the fund managers or pulling together with the bonds ETF. So that allows them to, in a way, mitigate certain risk in case of one bond or one company that go bust and
Yeah.
affected their whole portfolio.
Yeah.
So it becomes a very small percentage of capital that they put in,
Yeah.
even if one of these bonds goes south.
Okay.
Right. So I think it's a good way for retail client to go into the market with some risk control with very little startup.
Okay, I think to summarize, it's more like the common man on the street, right? They're able to access bonds at a lower startup investment amount, right? And they can also diversify fees at the same time, right? I think that sounds quite interesting, right?
Yep.
That sounds quite good. Yeah. So any other comments, any other examples you have with your clients, like buying bonds in nowadays?
I think a lot of Thai people will also look at buying bonds into an alternative compared to investing into equities, right? So potentially they'll find that it's a lower risk instruments. But of course, we also will encourage them to dollar cost average. So by going through funds, bonds ETF, they can actually do dollar cost averaging strategy, even on bonds.
Okay.
So that's one good example that I think a lot of clients actually adopting nowadays. David, that seems to be all the questions that the producer have for us today.
Yeah, it's a good time sharing together with you.
So we all hope that you have learned something from today's session on bonds. So see you guys next time. Bye-bye.
Goodbye.